Hello and welcome to a fresh new edition of Bazaar Morning Call. I'm Prashant, with me my colleagues Reema and Nigel. Good morning, guys. TGIF, as they say, right? Thank God it's Friday.
Yes.
And, we look forward to another decent session. So it's continuation of where we left off in trade yesterday in more ways than one. And I'll tell you why. You have a situation where the US 10-year continues to fall. There is market interest rates in the US, the 2-year, 10-year, all across the curve. The 10-year, for example, was down another 9.5 basis points. It's at about 3.5% now. This comes on the back of the fall we saw day before. Dollar index, that also fell. It's now under 105. We left off at about 106 or so. So that's pretty sharp fall in 2 days flat. US data was disappointing, which in a way was sort of good news because markets liked it. Most important data point is later today, which is the jobs number, and we'll talk more about that a little later. If that number comes through in a very weak fashion as compared to what the expectation is, that will light up some fireworks for sure. SGX Nifty is indicating a flattish kind of start, down some 50, 60 odd points, 18,918, a third of a percent lower. Reema, hi. Nigel, hi.
Yesterday was just a kind of a session of consolidation, right? Investors pausing on Wall Street. So by the end of it, the Dow was down about 0.5%, but the S&P 500 flat, the Nasdaq was up 0.1%. Some of the investors were perhaps questioning, did we get ahead of ourselves with that Wednesday's monster rally? Because as Prashant pointed out, we've got a very important data point awaited, the jobs data. The ISM manufacturing data was subdued. ISM manufacturing data showed the first contraction since May 2020, and that's also an important economic indicator. So, the mood on Wall Street changed to some extent. On Wednesday, it was exuberant, but yesterday there was just a bit of caution, some pause, some consolidation that we saw. The US 10-year bond yield now stands at levels of 3.52%, which 54% now, which compares with yesterday's level of 3.63%. The dollar index is eased to a level below 105. Very smart buying seen by the FIs yesterday, right? The FIs bought 2,600 crore in the cash. There was a DII buying, while the FIs sold about 1,500 crores. So some reversal.
Yeah, we had that very large number, right? Net flow number on. Maybe some reversal, but the point is that market sentiment, especially in the US, just to set things up, remains very, very positive. And when market sentiment is positive, it is usually a dollar negative, right? I'm talking about risky assets higher and the risk-free dollar lower, and that is essentially what is happening right now. This is out of the US. Now, US economic data disappointed. This is good news. ISM manufacturing, for example, the PCE number, that was weaker. So bad is good. And in the sense that, weaker data means lower hikes, etc. So that's good news. Treasury yields fell. The 10-year fell 9.5 basis points. The dollar index is down 105. The most important number, as I said, is the jobs number. The consensus expects about 200,000. And here's an interesting bit of trivia. Over the last several meetings, actually throughout the course of this year, actual numbers, actual jobs data has been about 26% higher than the consensus. So more often than not, in terms of the number of meetings, there have been only 2 instances where, the number has been weaker than consensus expectations. But things change. That's the nature of markets, that's the nature of data, and it's possible that the cumulative effect of all that we've been seeing out there starts to weigh in. So, you want to get to a position where the Fed feels that what it is doing is working in terms of slowing the economy, bringing down aggregate demand and things like that. And what they've put the most amount of emphasis on is the labor market data and hourly earnings, etc. So and that data usually comes right at the word go, right at the beginning of the US trading session. So we'll keep an eye. On the back of what we've seen in both yields, which are lower, and the dollar, which is lower, there are 2 sectors which were in focus yesterday. The IT services index, and that's a big one for the market as well. IT was, of course, the top performing index, mid cap and large cap, everything between 2 and 6%, depending on what you want to look at. And they remain well positioned because of this macro tailwind. We don't know company specific, and I think it's possible that all the way till the results season, which is only in January, you have a bit of a run. If these trends remain, the interest rates, market interest rates remain lower under pressure. And of course, metals is the other pack. Yesterday, again, that was another pack which both steel and non-steel did well. Dollar lower is positive for commodities. So that's another one to watch out for. Broader markets are participating, stock-specific, small, single stocks, mid-caps, small caps, etc. So I think that is, and we'll talk more about what has been in momentum. Mid-cap index, by the way, is up some 2% this week, a little over 2%. The Nifty is up 1.5%. So it started to sort of pull ahead, even despite the recent occasional pullbacks. On the Nifty, I mean, keep a trailing stop loss at about 18,700. I mean, the stop has got to keep coming up as the market moves higher. That's the point. So we've brought it closer. We're at about 18,800 or so. The opening indicates a lower start. Maybe that changes a little bit, as we've seen so often over the next 60 minutes by the time we reach there. But be mindful. If you're trading, I think always important not to get sucked into the euphoria. We're building up into a bit of a euphoric kind of moment where the market's been doing very well. If you're trading, you need to be watchful not to lose money as well. Nigel, what are you watching on for?
Well, yesterday, actually, the final tick of the Nifty was at the day's low. Yeah. It was weekly expiry that played out. And in fact, we ended closer to around that 18,800 odd mark. But because of averaging, well, that number looks a little bit better. The Nifty Bank, well, that didn't participate yesterday. But for me, the biggest positive was the broader markets participated. And I'd like to see more of the same, because that's what helps portfolios as well. So you had the small cap index and the mid cap index. They did reasonably well. You had the advanced decline numbers that got a little bit closer, but still, we ended on a positive note. Now, what did the FIs do in the FNO market? Yesterday, they unwound some longs, they unwound some shorts as well. But the clients, right, we have been tracking their positioning as well. And yesterday, they added more longs than shorts, which is good news. But they continue to remain net short on the index, mildly so, 48% of their positions on the long side, while the FIs, they stayed net long out there. What about the options data? Now, we're starting off a new series, new weekly series. So, look at the options data. The highest open interest on the call side is at around the 19,000 call. On the put side is at around 18,800 put. And yesterday, you had a fair bit of writing at the 18,800 call, at the 19,000 call, as well as the 18,800 put. So, just take a look at that. That's the premium out there. And the 18,800 call, the premium was around 150 to around 200 rupees. So those writers, well, they are hoping for that 18,950 odd level holding out. But the Nifty Bank, that maybe can move 1% or so higher from here. But it seems that some part of the street is positioning themselves that we run into resistance at around that 43,700, 43,800 odd. I say that because there was a big surge in open interest yesterday at around that 43,500 call. And it should run into resistance at around those levels. So just keep an eye out. Normally, we don't see very, very active options in the Nifty Bank. But that was one observation yesterday, which brings us to the Nifty levels. Resistance will be at around the 18,950 to around 19,000, going by the call writing that we've seen at around that 18,800 call as well as the 19,000 call, while support at around 18,700 put. And I say that because the premium at the 18,800 put is around 100 rupees. Subtract that and you'll get your stop loss. The dip will have to get bought into, 70 points low is what the SGX Nifty suggests. I think closer to around 18,700, that would be a good entry point. Reema, what else?
Well, some wise men opinion then. We've got Sanjay Mukim of JP Morgan who says MSCI India's meager returns in 2022 despite large EPS cuts mean that markets start 2023 with still elevated valuations. He says India's structural promise remains a significant long-term attraction, but the economy can feel pressures from slowing global growth in the near term. He expects another year of no index returns as earnings grow into valuation. He says financials are likely to sustain momentum and they remain overweight on staples as potential beneficiaries of the upcoming election cycle. He says JP Morgan is underweight on IT and the non-auto consumer discretionary as demand slows.
Okay, some money market views. This is Bhaskar Panda of HDFC Bank who says a spate of positive factors were responsible for the dollar INR moving downwards, like soft oil prices, comments suggesting lower pace of rate hikes in US. Consequently, the dollar index closing below the 200-day moving average yesterday and the Indian economy doing better than others. He expects the dollar INR pair to consolidate around 81 pivot and trade in a range of between 81 to 81.2 to $1 for the day.
On bonds, Bhaskar Panda says the Indian bond yields have been softening, taking into account global cues and expecting softer inflation at home as well. He expects the 10-year benchmark bond yield to trade in a range of 7.2 to 7.25% today, with a downward bias still intact.
Well, we've got plenty of stocks to track for you in terms of stock-specific action, and we get to that in just a bit in our special Top 10 segment, where we'll look at Hero MotoCorp, Westlife Food, Yes Bank, Paytm, ONGC, Oil India, Reliance, those are stocks on the back of positive news flow. While on the flip side, you have Eicher Motors, PB Fintech, and NNBC. They are stocks that could react to some negative news flow.